Today we're going to go over some of the most frequently asked questions over the last month. We're going to review our simple Forex trading system targeting 50 pips a day. In the second part, we're going to go over some examples of high of the day and low of the day setups. We're going to talk about the week ahead. Stay tuned. We'll be right back. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Huge week ahead of us. We had the global indexes close strongly down heading into the Friday night session. We're sitting at some critical points in terms of price levels. We're also at that point with a lot of the currencies as well. We may see some big movements again in the US dollar if the markets, the global markets, do head south again. I think we're in for another great week of volatility in the currency markets. Today we're going to review just briefly again our simple system. We're going to go through some frequently asked questions that have come up in the last 3-4 weeks that seem to be coming up again and again and again regarding some of the key elements. We're also going to go and review some examples, and I'm going to encourage you to be screenshotting some of the patterns that you're going to see over and over again at the low of the day and the high of the day, and embed those into your memory bank. We're going to talk about some live performance issues with some of these examples and what you're going to be faced with, and then we're going to be reviewing the week ahead and the key levels to be looking for. So one of the things that, just to review again, our structure, big picture geometry, that gives us an ideal situation for bigger measured movements, for targets. We want to be dealing near the high or the low of the day. Doesn't always mean that it's going to be at the exact low or at the exact high, but we're going to be working from the low or from the top. We're talking about our 00 boxes. Okay, we went through, and right now we're into some more volatility. Obviously our daily ranges have blown out. Fantastic opportunities for traders right now to be maximizing these markets. And then we talked about the 12 candle window around the market timings. Risk reward. We're going to just review a couple of concepts with this and live performance. So one of the emails that I received was about reviewing trades in hindsight, and one of the things that I keep going over and over and over again, and I've gotten some great feedback from a lot of the traders, thank you. The point of all of this is that it's not about hindsight. It's broken down so simply, right down to the candle pattern within a 12 candle window, near the high or near the low of the day, that even if you're just counting 1 candle, 2 candles, 3 candles, and asking yourself, is that a textbook perfect setup? It's not hindsight, it's right now. That's why we can duplicate this, we can improve upon our performance. We're looking for that pattern in that 12 candle window at the round numbers, at the market opens, near the high or the low of the day. It doesn't get any simpler than that. But there's going to be issues in live time that you're going to be challenged with. The speed of the price action, the spreads widening, the flashing of the price action, the momentum and the bursts of the candles. So it's important about preparing, having a game plan, and looking at the bigger structure to give yourself an idea. Am I looking to be buying low today? Am I in an uptrend and I want to be buying low? Am I in a downtrend and I want to be selling high? Is it a breakout pullback for a continuation? All these things where the preparation factor comes into play. So again, structure, we talked about bigger geometrical patterns, double tops, double bottoms, head and shoulders, reverse head and shoulders, descending triangles, ascending triangles, rectangles, 3 push patterns on the top, 3 push patterns on the bottom, V bottoms, V tops, different things, and where we're going to see those at. Day 1, day 2, day 3, midweek reversal, midweek continuation, one of those scenarios. Are we at the bottom of the week? Are we at the top of the week? Is the market hitting both sides? We could be at the bottom or the top on a level 3. The market will typically hit both sides on a level 3 area for a reversal. The whole week can be a level 3. So again, we're looking at big picture, and we're going to review some of this when we go over the week ahead in the second half, because I'm going to just show you what I usually do on Sundays to look at some of the key number levels with the price action at where we may be headed into the next week. So high of the day, low of the day, round numbers. We talked about double zero boxes. You might even be in a 300 pip box. We've had massive volatility. So typically though, when we head into the session, most likely we're going to be inside of a double zero 100 pip box. And that's what's important. Just be identifying, are we up high or down low? So the timings, again, this gives us our 12 candle window. Now we're going to go over this in a second with our frequently asked questions. But again, this narrows our window of timing down. Yes, there are trades outside of these windows occasionally, but again, this is where assessing that 12 candle window when the market sets up, maybe we aren't going to get our ideal entry or exit in that 12 candle window, but we may be able to see, especially if there's news. That's one thing we haven't talked about, is the calendar. And I'll just say this straight across the board. I do not trade the news itself. If I'm in a trade prior to the news, I will either exit that trade, take profits, cut my trade, whatever that may be, depending on which announcement that is. If it's interest rates, payrolls, the Fed, which I'm never typically up for anyways. We've had some emergency announcements that have caused big spikes, so some of those things are unforeseen. Funny, they seem to always come around the same time when they come. But again, I'm looking for that. If our 12 candle window, then we would bump that out a little bit further, because the market may use that announcement to stop hunt traders on either side before resuming the direction that it wants to move in. So I may allow that. I may wait for that 15-minute candle. I may come back an hour later. Or I may just come back in the next session once the market's digested that scenario. So risk reward, we're going to review this in the frequently asked question, because somebody's asked me a question about that as well. But again, just simplicity. This is completely duplicatable. It's simple. You can duplicate it. You can get better at it. You can scale it up and then repeat the process. That's what's important. There is no hindsight trading. This is going to show up again tomorrow. It's going to show up Tuesday, Wednesday, Thursday, and Friday, day after day after day. You've seen this now. The next part is up to you mastering this in live time. Knowing, are you getting in too soon? What mistakes are you making? Okay, quit doing that. What are you doing well? Do more of that. Keep focusing on what you're doing right. Do less of what's interfering with you achieving the goals that you want. And just to repeat, 15-minute charts, pound crosses. This week, this is all going to apply on the US dollar pairs, the yen crosses. It will apply in any pair, but the reason I focus on the pound crosses is that they provide consistent, reliable volatility week in and week out, even when we're not in these big ranging markets. But that said, we have had fantastic trades, and I will be looking at the US cross pairs. Canadian dollar, it reflects the price of oil. We're sitting at multi-year lows again on oil. The yen, it's a safe haven. When the dollar, the yen and the Swiss franc, two currencies that will move very strongly when the indexes or the US dollar are in trouble. Aussie dollar, it reflects the commodities, so it tends to be very weak. And again, if you want a short weakness, buy strength. So again, these are little things that when the US dollar is moving very strongly, I will look at some of the US pair crosses as well for these very same setups. I mean, it doesn't matter what pair you trade, whatever pair you want to trade, but this process applies to all of those pairs and all those markets. So again, we'll look at some examples afterwards of ideal low of the day, high of the day setups. And again, I encourage you to screenshot your own, build your little playbook. You're going to see the same patterns over and over and over again. You're going to see little versions of W's. You're going to see 1, 2, 3 shift candles. You're going to see single pin bar hammers at numbers after a measured move. You're going to see engulfments and then another second hammer. You're going to see at peak formations, you are going to see 2-bar reversals after an ADR has been hit on a blow off. usually 3 or 4 hours into the London session. That could happen in the blow-off in the US market. You're going to see versions of double topping patterns that are going to be 4 and 5 candle variations, the same thing. So build your playbook, get familiar with recognizing what these reversal patterns are going to look like at the high of the day and the low of the day. Screenshot them, make your notes. You're going to see the same thing. It's going to be at the high and low of the day. It's going to be at numbers. It's going to be within that 12 candle window on most times. Now often there's a 12 candle window at the close. We talked about the Friday night market, that we had measured move extensions. Instead of the stop hunt back, we had that 3-hour extension closing in strength in that US session on a lot of the pairs. And again, risk reward. So let's get into the frequently asked questions section now. What do you mean by the 12 candle rule? Okay, so this question keeps coming up a lot. We've talked about that 12 candle window around the market opens, that 3-hour window. We talked about the market moving in 3-hour increments. It might be 3 hours in one direction, 3 hours back into the move. It might be 3 hours in one direction and then a continuation for 2 to 3 more hours or into consolidation. This 12 candle rule is around the market opening time. So 8:30 p.m. New York Eastern Standard Time. That's another question that comes up a lot. What time is it where I'm at? I don't know what time it is where you're at, but I know everything is based on New York Eastern Standard Time. So 8:30 p.m. New York Eastern Standard Time is when Asia opens. Between 2 a.m. and 5 a.m. is when the Europe-London window is. Now, I've also said sometimes 1 a.m., depending on how the market has moved, there will be moves at the end of the Asian market when they've shifted it and gone sideways for a spring or up top for a spring at the end of Asia, and typically we'll see that at the high of the week or the low of the week. So the 12 candle window is that hour before the market opens, the hour of the market opening, and the hour after the market opening. So again, the whole goal of this is simplified. We want structure. We want to be working near the high or near the low of the day. We want to be working at numbers. We're looking at the market opening times, and we're narrowing this down to a 12 candle window. So a comment that I had was, that's great in hindsight, but this is the whole point. We're breaking this down to such a narrow window, looking for certain price patterns at the numbers at the high or the low of the day in relation to our bigger picture structure, that you only have to really focus on 12 candles. So it's almost impossible to not be at least seeing it and then hitting the trade, making mistakes, getting better. This happens day after day after day. So you have a 3-hour window, 12, 15-minute candles to focus, whether you're, if we're looking at our box, say the market's in an uptrend, where we could be seeing a 3-hour pattern down for a buy signal, an engulfment. We might see an engulfment. We might have a pin hammer already over here. We might see pins down here. A double at the low of the week. We might see a double bottom setup. We might see something where the market has been trending and it's gone sideways into a squeeze at the high for a measured move, a breakout pullback. But it will 90% of the time happen inside of this window. If you are chasing a trade, if the market has already moved and you're chasing it into this window, chances are that next 3-hour window is going to be a stop hunt or a peak formation for a reversal, which we saw a fantastic one last week on the pound Canadian. So again, that 12 candle window is the hour before the market opens, the hour of the market opens, and the hour after the market opens. Asia, Europe, London, New York. And the other question you want to be asking yourself in this window, are you in the trap or the trade? And yes, you can trade the traps, but if you're in a trap that's potentially exhausting the move or blowing off the move, we talked about creeping trends, blowing off, and again, we could see that on the level 3 where the technicals will take you in the direction of the trend. For a blow-off move, make sure you're taking money off the table. We haven't got into the 50 pip stop hunt reversals at the high and low of the week, but these happen all the time. High and low of the week trades, they blow them off for 50 pip moves. Traders hold on to them, they get stopped out. They don't take any money off, and this market explodes in the opposite direction. So hopefully that clarifies that. One of the other questions that I've been getting a lot is, what do you mean by double zero boxes or trading inside of the box? So if you look at any instrument, most of those instruments, depending on the time frame you're trading in, will be trading between double zeros. Now on the 15-minute charts, they typically, like on the pound Aussie, pound New Zealand, we may be in a 300 pip box, but they will be trading off of double zeros. Now they may actually go down inside of 50, double zeros, 50, double zeros. They may come down underneath and be buying underneath of the box for the move back up. Or they may come down and put pins down in this area for the move back up. They may come up on a 200 or 300 pip move and give an engulfment pattern for the reversal up high, you know, once they've met or exceeded the average daily range. But I want you to get the concept that basically you're trading inside of a box, and they may come out of this box and 3 pushes at the top of this box for another measured move of another 100 pips. Or in normal conditions, when the volatility hasn't been so crazy, we may be trading in a 50 pip box for a 50 pip move or a 100 pip move. Or down on the US pairs, most of the time people have asked me, why do you only trade the British pound pairs? Well, typically they will move in 50 pip tradable shifts, whereas a lot of the US pairs will only move 25, except when we get a Monday, Tuesday, Wednesday setup up high or down low for a measured move. Now, if I'm going to risk, 15, 20 pips on a trade, I want to be targeting at least 50 pips. But the concept is more about the 100 pip boxes. If you've been following now long enough, you'll see that the trades come off of numbers. If you get an ideal setup that's inside of a range, but it hasn't pinned numbers or engulfed at numbers, chances are you could be in the middle of a measured move and they've baited you with a trap. All the trades will come off of numbers 99% of the time. And that double zero, so again, the indicator is called sweet spots. It's a free indicator. I know there's other ones. I don't know. I use this one. It's easy. Okay? It's in the description box below. You can download it, put it into your platform. I don't know about other platforms, but I'm sure they have similar indicators. That will plot the zeros, the 50s, whatever, however you want to set it. So some people have asked me, do I just randomly plot those numbers? No, those numbers are what the currency is actually trading at, the numerical value. So it might be, 12900, 12850, 12800. That's the price. And typically, and Jesse Livermore talked about this, paying particular attention when shares approached $100, $200, whenever they approached that double zero area, how they handled that could determine if that was where they were going to reverse, or if, as we mentioned, they were going to layer on top and continue for a measured move. And that's what's really important, is that you're paying attention when the Asia box trades from the previous day's high, previous day's low, wherever it is. Have they come off of 50 and are they auctioning up for a measured move down? Have they come up at 50 and are they working the low for a measured move up to the high? Just little things like that. But the trades will come off of numbers, and ultimately you'll end up trading inside of 100 pip box, and they may have already gone down and come back up, and what they've done is snow plowed underneath. And if you're paying attention, you'll know that area underneath has cleared out orders, and when they come through, if they retest that low or if they retest a high, chances are they're going to do a measured move. So hopefully that clears that up. Double zero boxes, that's the price. You can use the sweet spots indicator. Hopefully that clears that up. Okay, the last question is, what do you mean by trap traders? So we sort of talked about this a little bit in some of the other videos, we talked about creeping trends and momentum. So often, creeping trends are the trends where we have these creepers, or they could be slow grinders working in one direction. They could be grinding down, but they're not really going anywhere, but they're congested. They may be in a 25 pip range, a 50 pip range. They may even be in a Monday, Tuesday, Wednesday setup. But effectively what happens is that the market will, paint a high and a low, and they'll be working one side. They may even come up, do whatever. But what happens when they've got their volume built up, this market will move very strongly in one candle, trapping traders who may have been trying to short this all the way down. So lower highs, outside structure, and then bang, in one candle, in 15 minutes, they will trap 4, 5, 6, 8 hours of trading, and they will take off from there. And again, just understanding that once they do that, if they come back down here, that allows losing traders to get out at either break even or without maybe even a small profit. And so therefore, if they go back, they're releasing all of that money. And when you can identify that and you understand what's happening there, you can confidently go into the market knowing that that may be the low or the high of the day. Now, we saw an amazing setup last week, which we get these on the US cross pairs a lot. We showed this on the Japanese yen. We had the 3 pushes. It went up a 4th time, gave us a nice ascending triangle into the high, broke out, retest, fell very strongly. Again, all this volume, all the technicals, all the EMAs, stochastics, trend lines, we're saying long. Breakout, retest long, taking traders, chasing it for the measured move for the breakout, and then bang. They shift that, and this is again where our geometry comes in. Measured move. Take 100, 200% expansions of those ranges, and sometimes it'll go more. But in any time frame, when you see creeping trends and you see volume getting caught up high or getting caught down low, be prepared and know whether we're in for a continuation. If you're in this trade long, you definitely want to be either taking money off. If traders who chase this up here lifted their stop or didn't use a stop or had too much leverage, these are the sort of trades that will blow out your trading account if you hold on to a losing position. First thing, trendline break, retest. Traders who were positioned up here would have been licking their lips for the measured move. This could have been a second day trade on a daily chart, even on our 15-minute system. When we see moves like this, second day trade. That's where we'll see that consolidation, maybe a breakout, retest, 3 pushes for the continuation. This will happen often in Asia. Again, they'll trap volume against the trend, 3 pushes, and then shift away quickly. They will shift away. They will wipe out 3 days of trading in 2 or 3 hours. So really important, if you see creeping trends or you see consolidated ranges, there's traders who are trapped in the wrong direction. They may be shorting. There may be a strong move up, and then we get a sideways market. Traders are shorting this up top, shorting it up top, and the market breaks out and goes for a measured move. Traders are short down here, holding on to a losing position. So you do thinking that it's going to come back down again. Make sure you pay attention to creeping trends, because they will usually, when they explode out of that range, move very quickly and strongly for a measured move. Really important. So hopefully you got value out of that, traders. Hopefully everybody's getting improvements in their trading. Again, keep it really simple. This is lifetime trading. You're going to make mistakes, but this is going to show up. Narrow it down to the 12 candle window. We're going to study some examples of high of the day and low of the day setups, and we're going to look at this week's levels on the pound crosses. Stay disciplined, stay focused, keep getting better, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined and may the markets go with you.